Hello and welcome to Smart Karma's corporate webinar. I'm Sanam Nanwani from Smart Karma. This week we are hosting First Right. We are glad to have with us Executive Director and CEO Victor Tan. We will start the webinar with Victor walking us through a company presentation, after which you will engage in a fireside chat with Smart Karma Insight provider Angus McIntosh. We are taking live Q&A. So I would like to request our attendees to post your questions in the Q&A tab at the bottom of your screen. During the webinar, we will also share some links on how you can connect with First Right and read more research by Angus. So please do keep a lookout for messages in the chat box. I now hand it over to Victor to walk us through a short company presentation. Victor, please.
Thank you so much, Sanam. Hi, good evening, everyone. Okay, I will just give a quick overview of First Right, and then, later I will have a chat with Angus. Okay, let me just give you a quick overview of First Right. Okay, we are actually the first healthcare real estate investment trust to be listed in Singapore Stock Exchange way back in December 2006. Okay. And our vision since then has always been that we want to become Asia's premier healthcare trust. Okay, we start with 4 assets during IPO, all coming from Indonesia. Okay, and that is actually coming from our very first sponsor, Lippo Karawaci. Okay, and of course, over the years, we have grown to, currently we have 31 assets that's span across 3 countries: Indonesia, Japan, and Singapore. Indonesia consists of about 76% of our total portfolio, and this comprises 12 hospitals, 2 integrated hospital and mall, 1 integrated hospital and hotel, and also 1 integrated hotel and country club. And over in Japan, we have 12 quality nursing homes, which contribute about 21% of our total asset portfolio. And in Singapore, we have 3 nursing homes, which is roughly about 3% of our asset under management. All in all, our asset size, our asset under management as of now is around 1.2 billion Singapore dollar. And our leases are all very long dated, all very long leases. Indonesia, the lease is about 15 years, with option to renew for another 15 years. And Japan, the leases are all 30 years. And then in Singapore, it's 10 plus 10. 10 years with option to renew for another 10 years. Okay. And our assets are all single tenant assets. Hence, our committed occupancy is 100%. Okay, as you can see from the slide, our weighted average lease expiry is very long as well because of our long dated leases, 13-year as at June this year. And we also have a very healthy financial position in that our current gearing ratio is about 35.6%. And our new sponsor since 4 years ago is OUE and also OUE Lippo Healthcare, which currently holds about 44% of the units, and also owns 100% of the manager, which manage the trust. Okay, go over to the next slide. Okay, since December last year, we have actually come up with a 2.0 growth strategy, which prioritizes the sustainability of our distribution to our unit holder. And this also helps us to pursue sustainable and long-term growth. Okay, these 2.0 growth strategies encompass 4 of these pillars. Okay, firstly, we want to diversify into developed market. Okay, so that we want to reduce our geographical and tenant concentration risk. And this is our target is actually to increase our exposure in developed market to more than 50% of our AUM over the next 3 to 5 years. Okay, which I shared early on in my overview slide that currently Indonesia exposure is around 76%. Japan and Singapore, which is the developed market, which is around 24%. And this is due to the fact that we have completed our maiden acquisition of our Japan portfolio sometime in March this year. Okay, so prior to this year, as of last year, our Indonesia exposure is around 96%. The remaining 4% is actually in Singapore. Okay, and this is the reason why we want to diversify into developed markets so that we have more stable growth going forward. And second of our strategy is to reshape our portfolio for capital efficient growth. Okay, which means that we want to recycle capital from non-core and non-healthcare asset, and also for healthcare asset, but those mature assets we also want to be able to recycle. Okay, and if you saw from our portfolio early on that we do have some non-healthcare asset in our portfolio. For instance, we do have 2 hotels and also 2 more that is kind of like linked to our hospital, and these are assets that potentially we could divest and or recycle our capital into a more capital efficient growth area. And third pillar is also to strengthen our capital structure so that we can continue to remain resilient. And this involves diversifying our funding sources so that we can continue to optimize our financial position going forward as we continue to grow. And last but not least, we want to be able to continue to pivot to ride the latest mega trend. For instance, the ESG, environmental, social, governance, which is the thing right now, and we also want to tap on the aging population demography and also other growth drivers, even as we pursue our growth going forward. Okay, so in line with this 2.0 growth strategy, we want to be able to continue to harness the stable growth in our Indonesia market. At the same time, we also want to be able to diversify into developed markets so that we can grow our stable income going forward. And that we also want to be able to continue to leverage on our strong healthcare and real estate support, mainly coming from the strong support, strong link that we have with our sponsor, OUE and OUE Lippo Healthcare. Next slide. Okay, a quick overview of our master lease arrangement in Indonesia, our very core market all this year. And you can see that Indonesia, vast population, 260 million people. But if you look at the healthcare statistic, there is really a lot of demand and also lack of quality healthcare services as well as healthcare facility over Indonesia. Indonesia only has 1.04 hospital bed per 1,000 people, which is actually very, very low, compared to other ASEAN country as well as most of the developing country as well. Okay, and also the Indonesia economy has been growing steadily over the past many years as well. So this has caused there's a growth of this middle income group coming up. So, and coupled with this introduction of the universal healthcare system in Indonesia has driven very strong demand in the healthcare sector, and we want to be able to tap onto this growing middle income as well as this growing demand as a result of this government push in the healthcare industry. Okay, so I just want to explain a little bit of our master lease arrangement prior to 2021. That means before restructuring and after we have restructured our lease arrangement. Okay, the base rent escalation before the restructuring is based on 2x Singapore CPI. Okay, but there is a cap at 2%. There is also a floor, which is floor at 0%. The reason why we are using Singapore CPI is because the rental income before the restructuring is received in Sing dollar. Okay, hence we are using the Singapore CPI as a benchmark, to compute our rental escalation. Okay, and if you look at the variable or the performance base rent, there is a variable component, and this variable component again is also capped between 0% to 2%, and this is actually applied on a function of the hospital gross operating revenue. I'd like to mention that this variable rental is a very small component to the total rental income before the restructuring. On average, is between 1 to 3%. And this variable component is not cumulative. Okay, so every year, depending on the hospital performance, we will have to compute the variable component. And if the hospital are not doing well, we will not even have any variable component going into the following year. Okay, and the total rental payable is base plus variable. So assuming that if there's no variable component, then it will only be base for the following year. And the tenure is 15 years with option to renew for another 15 years with mutual agreement. Okay, so post the restructuring, our base rent escalation is 4.5% annually. Okay, and there is a performance base rent, which is based on the 8% of the preceding financial year hospital gross operating revenue. So the formula is such that it will be based on the highest of base plus 4.5% increment or performance base rent, whichever is higher, and this is measured on the hospital by hospital basis. Okay, so you will see that some hospital, if they do well, they will pay us based on their performance based rent. If the other hospital haven't performed as well as we would like to, they will pay us the base rent increase 4.5% annually. Okay, and in terms of tenure, it's similar to before restructuring, 15 years with option to renew for 15 years based on mutual agreement. And of course, the currency now is Indonesia rupiah. Okay, and as part of our recycling or capital recycling strategy, we also have divest Siloam Hospital Surabaya. This was actually one of our IPO asset. We held this asset since IPO about 16 years ago. And the reason why we are divesting this particular hospital is because this hospital was actually built in the 1970s. So to us, it's already a very mature asset for us. And we thought that this we will be able to realize the full value, by disposing this asset to the operator, which is Siloam Hospital Group. Next slide. Okay, just now I talked about the developing country, which is Indonesia. Now I want to talk about this developed market that we have just got into. Okay, in March this year, a couple of months ago, we actually completed our maiden acquisition, into Japanese nursing home market. And this particular portfolio actually comes from our sponsor, OUA Lippo Healthcare. Okay, and these are 12 high quality freehold nursing homes, which are well placed across Japan. 7 of them are in Hokkaido, and then of course the other 5 are in Nagano, Kyoto, Nara area, which is more southern part of Japan. Okay, and there are 3 nursing home operators that operate these dozen of nursing home in Japan, and these are independent, well established, as well as very experienced local operator. And in between the 3 of them, I think they have more than 20 years of operating experience, among the 3 of them. And the leases are all very, very long dated, 30 years, okay, which only expire sometime in 2043. And in terms of annual rental, Okay, the rental will be revised every 2 to 3 years upon negotiation, and this is actually based on the increase in Japan CPI or interest rate. Okay, maybe just a quick numbers on this particular nursing home. This particular nursing home, as at June 2020, the valuation is about 25.2 billion Japanese yen, which is equivalent to about 250 million Sing dollar. Okay, in terms of weighted average lease expiry is about 21 years. And I mentioned earlier on, these are all operated, single tenant operated by operators. So these are 100% committed occupancy. And the title of this nursing home are all freehold, 100% freehold. Okay, and the total gross floor area of this nursing home is about 90,000 square meter, and which comprises about 1,450 rooms in this Charles nursing home. Okay, a quick slide talking about our capital structure. Okay, we have been strengthening our capital structure over the past 2 years post the restructuring of our master lease agreement. Okay, our current gearing is about 35.6%. Okay, which means that we do have some headroom. If you were to gear up to 45%, we have a headroom of about 200 million Sing dollar. Okay, and our average cost of debt post the Japan acquisition has come off to about 3.7%. Okay, if you look at our debt maturity profile, yes, we do have half of our loan, about 250 million, that's up for refinancing in first quarter of next year. We have started negotiating with the lenders to refinance this loan about 2 months ago. We don't see the problem, to refinance. It's a matter of interest rate, it's a matter of margin. But with a stronger financial and capital position right now, I think we should be able to negotiate better rate, with our lender now that we are stronger post the restructuring. And if you look at the other two debts, one of them is actually the TMK bond. This is only due in May 2025, and this particular bond we assume over when we acquire our Japan portfolio in March this year. So this is actually the debt that is associated with this Japan nursing home that we acquire. And of course, another piece of debt is only due in 2027, and this is actually the CGIF guaranteed social bond. This is actually the first ever healthcare social bond in Singapore, and this was the healthcare social bond that we managed to issue sometime in April this year. This is 100 million 5-year guaranteed bond, and this is actually guaranteed by CGIF, which is actually the trust fund of the Asia Development Bank. Okay, and the social bond was actually issued in April this year, and is payable semi-annually in the arrears. This is talking about the coupon payment. Now, of course, this is rated by S&P, rated AA by S&P, and I also shared earlier on that this was guaranteed by CGIF. Okay, and this is the first time that CGIF has provided a credit guarantee to a social bond issued within a REIT market and a debt market in Singapore. Okay, so we are very honored to be able to do this social bond, which tie in very well with the strategy that we have, riding on the mega trend, riding on the ESG trend that we shared about early on. Yeah. Next slide. Okay, post the restructuring, we have been able to deliver very stable DPU since then. If you look at our net property and other income, NPI in short, we are able to deliver very consistent and growing NPI. Okay, And in terms of DPU, we've also been able to give up very stable and very consistent DPU for the past 6 quarters. We pay out our dividend on a quarterly basis. Okay. And if you look at the NPI, we are also able to reduce our concentration risk this year. If you look at last year, as I shared earlier, 95% of our NPI, actually come from Indonesia. Only about 5% is in Singapore. Okay, but this year, as we grow in Japan, our contribution, NPI contribution in Indonesia has dropped to 8.1%, and then Japan is now 8.4%, Singapore is about 3.5%. So as we continue to diversify into different markets, you will see that our Indonesia component will drop even more. Okay, and in the past, most of our channel or a record number of percentage come from Indonesia, but with the diversification strategy that we have now, we have more third-party tenant, and the non-third-party tenant is only 2, as compared to in the past where majority of our tenant are basically non-third-party tenant. Yeah. Okay, so this is a slide that shows our asset, which mainly comprises hotel and hospital and nursing home in Singapore as well as in Japan. But our mandate is not just in this hospital and nursing home. In fact, we actually can look at healthcare or healthcare related asset that is actually in Asia as well as outside of Asia. Okay, and when I talk about this healthcare or healthcare related asset, it's not just confined to hospital and nursing home. We can actually look at maybe assisted living, senior living community, and also other ancillary healthcare facilities such as medical suite, medical office, or even specialized pharmaceutical storage, outpatient facility, life science, innovation, and also research assets. Right? Anything that got a healthcare element, potentially we can actually look at it. And I just want to conclude my presentation to say that with strong sponsor support and also our 2.0 growth strategy in place and in motion, we are committed to balance growth and also stability in our portfolio and to be able to deliver sustainable distribution to our unitholders.
Great, Victor. Well, yeah, thank you very much. Very sort of concise view of First REIT, and some obviously some very interesting changes going on with diversification into more mature or more developed markets, I would say. It might be worth sort of starting off just for the benefit of those in the audience who haven't followed the company for that long, just to give a little bit of background as to why choose Singapore for a listing. I know there's obviously a big community of REITs and listed REITs in Singapore. What was the reasoning behind listing in Singapore as a start?
Okay, yeah, okay, maybe that give you opportunity to share more about the history of First REIT. Like I said earlier on, we are actually the first healthcare real estate investment trust to be listed in Singapore Stock Exchange way back in December 2006. Okay, and our very first sponsor was Lippo Karawaci. They are listed in Indonesia, Jakarta Stock Exchange. And obviously, back then, there isn't any REITs or similar kind of REIT structure in Indonesia. Hence, they look at Singapore as the destination to list the REIT. Okay, and okay, when they actually started, they looking at they are in the healthcare business and they are actually growing their healthcare portfolio at the time. Hence they've decided to list a purely healthcare REIT. Okay, and the reason why they are doing that is because I shared earlier that they are growing. Hence, they are using, the REIT structure, as their, capital to raise, capital, and with this asset-light strategy, so they will be able to grow, this particular REIT, because they actually have a very strong pipeline for us, as year go by. This is the reason why in the very first 10 to 12 year of our listing, we actually grow very well, because every year we are able to acquire 1 or 2 assets coming from our initial sponsor, Lippo Karawaci. So we are able to grow very steadily. From 4 assets, we are able to grow to 15, 16 assets. For the past 10 to 12 years, because every year we are able to acquire 1 to 2 assets coming from our sponsor. Okay, yeah.
Very good. Well, and yes, yeah. I mean, a follow-on question. I mean, obviously, Indonesia has had very strong growth in the build-out of hospitals, and Siloam is the kind of the market leader. And Siloam is still, I know Siloam quite well, and they're still expanding their portfolio, although it is a little bit more slowly than previously. But do you still see opportunities to acquire Siloam hospitals going forward?
Yeah, definitely. I mean, if you look at Siloam Hospital Group as of now, they actually operate around 40 plus hospitals, of which we only own 15 of them, and we are actually selling 1 back to them. Okay, yeah. Okay, but notwithstanding this, and in the past, is like, I shared earlier, every year they do offer 1 or 2 assets for us to actually look at, but that was actually before the restructuring that happened about 2 years ago. So post restructuring, obviously, market is a bit concerned that if we were to do anything with them again, what will happen, especially post the restructuring, but now that we are able to put those issues behind us, anything that we were to talk to them or negotiate to them, it will be on a fresh footing, and I'm not saying that we will definitely say no, but we are just not confined to them as well. I mean, we can also look at third-party Indonesia asset or third-party Indonesia hospital. Okay, so what I'm trying to say is that we are not closing the door, even though our mandate currently is that we want to diversify into developed market, but we will never say no to the Indonesia market as well. Okay, so if there is good asset, good hospital that is able to meet our criteria, like for instance, if there are growth in the particular hospital and they are able to pay us very stable or sustainable rental, or which give us a very good yield, and we are able to fund it, and if it's operated by good quality operator, be it Siloam or be it third party, definitely is something that we can potentially look at it. And I also shared early on that one of our growth strategies is to diversify non-core, non-healthcare, even mature asset. So we can actually look at maybe selling mature hospital and buying some not so mature hospital, maybe developing or growing hospital. Hence, we will be able to manage our portfolio accordingly. This metric about 50% or more than 50% outside of Indonesia, or 50% or more in the developed market. These are metrics that we can manage, in the sense. Yeah.
Right, and just on Indonesian hospitals, how do, in terms of returns and the potential yields that you can realize, are the hospitals because it's a high growth market, and obviously, the hospitals are coming from a kind of, once they break even, they're throwing off, growing quite quickly in terms of profitability. Obviously, COVID situation aside, but is Indonesia effectively a higher growth and possibly higher risk market?
It is. Indonesia is a developing market, as per se, and I also shared in one of the slides early on that there is really a lack of quality healthcare facility in Indonesia, and consider that they have a huge population, 260 million, and continue growing. and they also have a rising middle income, which is very, very good for our hospital, because if you look at the Siloam Hospital, basically they're targeting at all these business income people, and definitely there are a lot of demand, and also government over the last few years have been promoting this universal healthcare insurance system. Hence, they are able to create even more demand, because the Indonesian government also want to make sure that everybody will have access to very basic healthcare treatment. Hence, by providing a lot of this subsidy support, to the hospital operator, this has created even more demand. So definitely we will see a lot of demand in Indonesia. And Indonesia, if you look at our Indonesia portfolio, it continues to give us very, very good return, 8 to 9%, largely also because of the growing market over there. Obviously, a bit higher yield will also entail a slightly higher risk to us, which is what happened a couple of years ago.
And I mean, I guess the new master lease agreements, you've gone into it in quite a lot of detail, so we don't need to speak about it in more detail again. But there's a currency exposure there, isn't there, to rupiah rather than Sing dollar, which obviously was actually beneficial prior to the restructuring. But the rupiah now does seem to be a more stable currency. Obviously, it's held up very well over the last few months versus the rest of Southeast Asia. So, but do you see that as a risk? And is there any way of hedging that risk?
Of course, Indonesia rupiah currency has always been a risk, in the past, and this is actually one of the reasons why we have to get into this restructuring 2 years ago. I mean, we are fortunate that post the restructuring, the Indonesia rupiah currency has been very, very stable. Not just the last 2 months. In fact, for the last 2 or 3 years, it has been very, very stable. But nobody knows what will happen, going forward. So definitely, we will be looking at hedging, this Indonesia rupiah risk going forward. Another way for us to actually hedge the Indonesia rupiah exposure is also by diversifying into developed market, because we also have done some study, and statistics show that there is some, or rather there is no relation between currency in the developing market and currency in the developed market. Okay, what this means is that currency in the developing market, for instance, rupiah, if we were to depreciate, there's a strong likelihood that currency in the developed country will appreciate. So there is a bit of natural hedge, in that sense. So for instance, our Indonesian rupiah could fallen, but the Japanese yen could strengthen, so that will actually help us to manage our currency exposure going forward. Obviously, currently it's the other way around. The Japanese yen has been depreciating, but the Indonesia currency has been very stable, in the sense.
Yes. Yes, well, obviously there are a few exceptions to the rule, like sterling in the UK has been a particularly poor performer, but you don't have any investments in the UK, so we don't have to worry about that. It might be worth just now sort of talking a little bit about the strategy in diversifying the portfolio, and obviously Japan is a very attractive market as in terms of the aging population, and nursing home seems to be a kind of captive market in a sense. I mean, can you give a little bit of background about how that investment came to be, and do you see more opportunities in Japan, or are you really focusing on that country, or are you looking at, you've mentioned in the presentation other countries, Australia being one, and Europe obviously, maybe a little bit more background on that overseas strategy. Great.
Sure. Yeah, you see, all this year, since the listing of the trust 15, 16 years back, all this while we always have been, in fact, our very first few assets actually come from Indonesia. So we actually have 100% Indonesia portfolio at the very beginning, and subsequently, we also know that, we need to be able to diversify. That's why in the subsequent year, 1-2 years after listing, we have actually acquired some asset in Singapore, and we even have gone to South Korea, to acquire, to test market, by acquiring a very small rehab hospital over there, but obviously our experience, didn't quite turn out for the Korean market, But all this while, we know that we probably need to diversify, we diversify out of the geographical risk, tenant risk, it's just that our very first sponsor, have a very strong pipeline for us, hence, we continue to focus on Indonesia. We are able to acquire 1 or 2 hospitals over there. But 4 years ago, when our new sponsor come in, OUE and OUE Lippo Healthcare come in, obviously they do not have any asset in Indonesia, and their asset are in Japan, this child nursing home in Japan, in other countries like China, Myanmar, even some real estate in Malaysia. So they have been saying that maybe we should be diversifying. So obviously 2 years ago, when we restructure our master lease agreement, we have a lot of issue, and hence we feel that diversification is definitely the way to go. Post the issue. Even before that, we are looking at that. It's just that post the restructuring is even stronger, for us to actually go into the diversification mode. Okay, so the Japan portfolio is obviously it comes, when our new sponsor come on board. But even before that, we are also exploring the Japan nursing home market, because we know that our only one competitor, they actually have a very sizable portfolio in Japan. Hence, we know that Japan portfolio actually give us a very attractive yield. Of course, if you look at the yield per se, 4+%, 5% is not as attractive as our Indonesia portfolio, which I said earlier on, it give us about 8-9%. But if you look at the funding of the Japan portfolio, we are able to fund it very cheap at maybe 1%, 1+%. So they give us a very good margin. So the Japan asset will be a very good position for us to definitely look at. This is the reason why, of course, with the help of our new sponsor, we are able to got our very maiden acquisition in Japan, and that actually give us a foothold for us to actually grow even deeper, in Japan. And Japan is definitely one market that we will be able to continue growing. Like I said earlier, the yield is about 4-5%. Good yield, not a very stable yield, and also in terms of the funding arrangement is also a lot cheaper as compared to other developed market. In the midst of this rising interest rate environment, Japan at this moment haven't really seen any hike in their interest rate environment yet.
I would guess, because obviously the yen weakness has an impact, I guess, on the yield to some extent, but it also is potentially quite a good time to be acquiring Japanese assets.
We will be able to buy it cheap this time.
Cheaper acquisition costs.
That's right.
So do you have a sort of pipeline of potential acquisitions in Japan, or is it sort of somewhere where we can expect to potentially see some further developments?
Okay, our sponsors do not have any more pipeline in Japan for us, so any acquisition will be coming from third party.
Right.
Yeah. So I think there are many nursing home in Japan, thousand of them, more than 1,000. So potentially we can look at adding some of the other nursing home in our portfolio. I certainly hope that we will be able to acquire a couple more, before the year run out. But definitely Japan is something that we will be exploring.
Right. So you could potentially move to acquire some, but they would be from third parties. Do you have any? Have you executed on any third party transactions to date?
Yes, we have done some third party transactions. Like for instance, the portfolio in Singapore, the nursing home in Singapore, all these are coming from third party. you know.
Right.
And even in Indonesia, we also have done a couple of hospital and other asset, you know, coming from third party as well, you know. Yeah.
So is that a more difficult process in terms of negotiation with third parties, or I mean, I guess it's a market yield and
may not be the case, you know, because I think third party acquisition may even be slightly easier as compared to related parties transaction, because related party transaction you need to go through all the scrutinies, you know, for independent unit holders, you know, you need to do more work to justify why you're buying at the price at the kind of yield, you know. Where third party is really purely at arm's length, you know. So I would say it's definitely a lot easier, you know, as compared to coming from a sponsor, you know, in that sense.
Yeah.
Yeah.
And you know, in terms of sort of, you know, other interesting markets, I mean, obviously, you know, Australia has a very well developed healthcare system, and you know, it's quite I mean, it may be too mature for you, but is Australia an interesting market for you from a?
It is. Yeah. I mean, Angus, we actually look at Australia. I mean, we have actually been looking at Australia. It's just that, you know, in the midst of rising interest rates, so it makes us a little bit tougher. You know, if you look at the Australia assets, I mean, it's also give us very decent yield, 4 to 6%, depends on location, right. Depends on the type of asset. You know, but it's just that the funding cost is a bit high at this moment because of the rising interest rate. You know. Yeah. So when the interest rate environment is more stabilized, you know, perhaps it may be a good time for us to actually do something in Australia. But definitely, you're right. Australia is a market that we also have publicly say that this is a market that we will explore as well. You know.
Okay. And sort of Europe, I guess, is a similar case in point, is it? Just in terms of
that's correct. US, Europe, even UK. You know, potentially these are markets that we can look at. But I would say the immediate target will be in Japan and maybe a little bit further in Australia, you know, before we start looking at other geography, you know.
Right, very interesting. But the long-term plan, as you said earlier on, is to have a 50-50 exposure between Indonesia.
May not exactly be 50-50, but I would say that we want to have perhaps at least an even spread in a developed market, or even more in developed market, you know, as we are able to find asset. Yeah.
Very good. And do you provide any guidance in terms of this year or any future guidance? Is that something you do or not?
No, all I can say is that now that we have restructured our master lease arrangement, we have recapitalized our balance sheet, you know, and also we are able to refinance some of our debt. Going forward, we are actually refreshed and we are ready to expand. We are ready to grow, and we also have a very strong sponsor, OUE, and also OUE Lippo Healthcare, which definitely will provide a lot of area that potentially we can grow. You know, so definitely we'll be looking at growing our portfolio, you know, in time to come.
Right. And I guess the next event is the refinancing, which you're obviously negotiating at the moment in terms of your debt.
Yeah, it is. It is. I do not foresee any problem with the refinancing. It's a matter of in terms of the margin, in terms of the interest rate, and some of the term and things like that. You know. Yeah, but definitely will be done. Yeah.
Very good. And just to finish off with, I mean, obviously you mentioned ESG as it's obviously a very important sort of part to any company's sort of governance structure now is having a good strong ESG policy. But you obviously gone some way towards that with your sort of social bond.
It is. Maybe I will let my ESG expert, you know, my IR person, Per, to actually elaborate a bit more on the ESG initiative that we have been doing on this one. Yeah.
Yeah, sure. Happy to jump in. Hi everyone. I'm the IR manager at First REIT. So on the ESG front, we are very committed to ESG. We've done several things on the environment front. You know, we are engaging with our operators to get them to use like more eco-friendly equipment, for example. Like using more environmentally friendly fire extinguishers. You know, having them the fire extinguishers on standby in the hospitals in Indonesia. We are also using engaging the operators to use more LED lighting. And in fact, already 64% of our portfolio is on LED lighting, and we are hoping to increase this by 5% this year. We are also reducing the use of mercury devices, which could lead to the poisoning of the waters. And so we are engaging our operator in Indonesia to reduce such devices, and as well as using more eco-friendly refrigerants, for example. So that's a sample of what we're doing on the environment front. Of course, more can be done, and hopefully when we get more data, we can also report on this in our sustainability report this year. And and then just quickly jumping on the social front, we see that social is part of our DNA, given that we are in the healthcare business. We're a healthcare REIT. And because of that, we see that there's an opportunity for us to tap on the social finance instruments to channel investments to projects that have demonstrated social benefits, and contribute ultimately to the United Nations SDG goal of good health and well-being. So Victor earlier on in the presentation touched on the the low number of bed count in Indonesia. So there's actually a lot of scope for improvement there. And so to the end, we've been able to successfully issue that social bond that Victor spoke about. Yeah, and of course, governance is how we it's done at a very senior level. Victor is chairing the sustainability team in First REIT, and in this team we have representatives from the various departments. So I'm part of that team. We have also colleagues from the asset management and compliance team in this driving the sustainability initiatives. And of course, at the board level, right, as you might know, SGX has mandated that one-time training, which our board of directors are going for. And so I think be it E, S, or G, we are looking into it. We are committed to improving in it as well. Yeah,
that sounds very, very impressive, and a lot of effort going on in a number of different areas, which is very important. But we're actually now sort of getting to the end of our time, Victor and Pearl. Thank you very much, for a very interesting discussion. And I'm now going to hand it back to Sanam to close the proceedings. Thanks very much.
Thanks, Anna.
Thank you.
Thank you.
Thank you, Angus, for some very interesting questions. Also, a big thanks to Victor and Pearl for a detailed insight into First REIT, the challenges in the real estate sector, and opportunities of First REIT. I would also like to thank our attendees who joined the session live. With that, I would like to wrap up this week's corporate webinar. Thank you very much again, and have a great week ahead.
Thank you so much.
You.
Thanks.
Thank you very much.
Thank you. Bye.